All right. Hope you're having a great summer and a great summer Friday. Well, we've had another busy week, in part because of lots of earnings stories and all-time highs for stocks. Keep your seatbelt on, because we're wondering what's going to happen on the trade front moving into the current August 1st deadlines that have been set by the White House. And we also have some key central bank decisions to be watching heading into next week. To digest it all, we're joined by Earl Davis. He's head of fixed income and money markets at BMO Global Asset Management. Earl, nice to see you.
Pleasure.
How's your summer going?
So far, so good. Can't complain.
Can't get away from the Bloomberg terminal too frequently. Let's just start with the general mood of the markets. I know you focus more on the fixed income world, where I think people are generally always a little bit more skeptical than the equity traders about sort of what's happening in the economy. But there's been exuberance,
yes.
It feels like, on Wall Street and Bay Street. What's your assessment?
There definitely has been exuberance. Having said that, we do expect the exuberance to continue. There's only two things on our radar that can knock the exuberance off. One is inflation, and we don't expect to see those higher inflation numbers till later this year, so we think we're all right for now. And the other one's higher interest rates. And right now, that is dependent upon, next week. What does the Fed say? What does the Bank of Canada say at their central bank policy meetings? We don't expect any change, but we still expect them to have a slightly dovish tilt, which should be supportive of this market.
Okay, so what is the biggest challenge for a central bank like the Bank of Canada, just as sort of an example right now?
That is a great question, and I would say the one word to capture it: anticipation. Anticipation of inflation. Obviously, we're not seeing the spikes of inflation that people were immediately expecting after the tariffs, but we do expect to see it. And part of the reason why we haven't seen it is just an inventory drawdown. Companies loaded up on inventory pre-tariff earlier this year. That's being drawn down, and now they're going to have to start purchasing things at a higher price, and that will be passed on to consumers. So one thing that's interesting in regards to the price point and this passing on, the Bank of Canada doesn't know where that will be yet. The FOMC doesn't know where that will be yet. So they're just steady as she goes, because employment seems to be stable.
Okay, I'm going to admit I am a tad confused, because if there is a inflation worry tied to everything that's going on, there is still conversation about rate cuts on the table.
Yes.
So can you kind of piece those two together for me?
Yeah. So yes, I can. So fundamentally, the market doesn't need rate cuts fundamentally. And how do we see that? What we look at is the unemployment number. The unemployment rate is not going higher in Canada and the U.S., at least for the last few prints, and it seems to be steady. The other thing is growth. The growth numbers are starting to come back along, and the reason why growth is not negative and starting to come back along is there's one thing, obviously, the big, beautiful bill impacts expectations, brings exuberance, as well as there's a deregulatory move in the U.S. where they're cutting regulation. It makes it cheaper for businesses to operate. So I think these things are very supportive of the market. So then the question is, why are we talking about eases? There's one specific reason in Canada, and one specific reason in the U.S.
Okay.
Let's start with Canada. It's the easier one. It's the housing market. We all see what housing's doing. We all see what condos are doing in regards to sales. The thing that is supportive of sales and getting more sales in the housing market is lower interest rates. Having said that, that's not a Bank of Canada focus or target, at least not directly, but they do look at that indirectly. So that's one reason why there's possible reasons for eases, and we think that will be a driver for eases in Canada going on later this year. Now in the U.S., it's all political. We see the headlines every day about this Trump-Powell, I would call it tension, because the Fed Chairman Powell does not want to ease interest rates. He sees it, as we discussed, the economy's doing all right, unemployment's doing all right, but obviously President Trump wants it, and why does he want it? Lower interest rates puts equities higher. Lower interest rates helps growth, helps fund the new tax bills, the tax cuts, I should say. And that's why he's looking for putting pressure on the Fed governor to cut.
And I even had a guest in the U.S. this week who actually talked about the U.S. housing market, making the case that lower interest rates would be a helping hand in that world where a lot of people get sticker shock here on mortgages. They did there as well. But can you just elaborate on the Canadian housing market, because I think given everything else that's going on, it doesn't get as much attention in the daily market conversation. So if there's a likely need to cut interest rates to address some of the housing issues right now. Can you spell out what those housing issues are?
Yeah, there's one other thing that's supportive of housing, why they haven't cut rates yet. And
Okay.
I'll get to that in a sec. Just the housing, it's just the cost of new mortgages compared to 5 years ago. It's very simple. We're getting the renewals come about. That costs, every dollar more you put into your mortgage payment is a dollar less that goes into the economy. It's very, very hard.
Yeah.
The reason why the Bank of Canada hasn't cut because of housing yet is employment. The number one most important factor for housing is actually not interest rates. It's actually employment. And the reason why that is, people need to be employed to pay the mortgage. They need to be making those dollars to pay the rent, to pay the mortgage, to buy a house. So as long as we see the unemployment rate or jobs not being cut in Canada, we got a surprise raise in jobs, more jobs being created last month. As long as jobs are not going lower and lower, like people losing their jobs, housing market will be supported, but at a steady rate, it won't rise.
Okay, so just to bring it all together, earlier this year with all the trade war worries, we didn't know where the Canadian economy would land, just based on people sort of trying to put it all together right now. Even though there's still plenty of uncertainty, the economy has fared better than what people thought, which means there's a lot of people who are still gainfully employed.
Yes.
But the Bank of Canada is watching what could happen if there was a change to that and what that would mean for the housing market, while also balancing the fact that we're still not sure if this trade story is going to lead to inflationary factors, which they don't want to get out of hand by cutting interest rates. That's kind of our soup bowl right now.
Yeah, so let me just put it very. The only thing the Bank of Canada, I'll put it again, the only thing the Bank of Canada focuses on is inflation. That's their mandate.
Right.
Keep it within a target. Why inflation? Because inflation impacts growth. And then growth impacts housing and employment. And that's how they kind of look at it. Yes, that's the Super Bowl.
Okay, and then at the end of the day, I think you alluded to this earlier, like this concept of fighting the tape, right?
Yes.
Like we got all that stuff, but at the end of the day, at least in equities, I know you're the fixed income guy, but in the equity market, we've been at these all-time highs. I would say most people, guests might sort of say, good to be cautious at this point, but I'm not hearing a lot of strategists who are saying, get out. Like, I feel like most people have been saying there's some momentum here, and fighting that would be possibly to your disadvantage.
I fully agree with that. We subscribe to that, but we've reduced our exposure, but we're still long the market because we see it grinding higher.